Well, good morning, everybody. It's 8:30. Time to start. Welcome to the KPMG Budget Briefing 2020. My name is Tony Mancini, and I'm joined this morning by my colleague Paul Beale. As you all know, we took the decision in the interests of everybody's health and seeking to contain the coronavirus, and also following procedures both KPMG and many other businesses have introduced. We thought we'd cancel our usual seminar and move to an online event, which is a bit of a new venture for us. So do bear with us. Obviously, we miss out on the breakfast, I'm afraid. So I hope you'll feel some sympathy for Paul and I when, as soon as we finish this, we go and eat 150 breakfasts. You do miss out a certain amount of networking. Hopefully what you won't miss out on is the ability to ask questions. As you look on the screen, you'll see that there's a chat function on the right hand side. You just click on that and you can type in any questions that you have. So what we're saving some time at the end to answer those questions, but do feel free to ask them as we go along. And so we'll then sort of save up and deal with the questions right at the end. And hopefully this online format will prove just as informative as we have done in the past. There's, as well as our format, quite a lot about this budget is unprecedented. We talked about it being budget 2020, but actually this should have been budget 2019, which was supposed to have been presented last autumn by the Chancellor at the time, Sajid Javid. The budget was postponed because of the election, and then Mr. Javid resigned. So the precedence for this budget was unprecedented by itself. And then new Chancellor, Mr. Sunak, had very little time to prepare for his budget, and I'm pretty sure that just after he started writing his speech, he probably had to rip it up and start again, because almost immediately it became apparent that the unprecedented impact of the coronavirus needed to be addressed. And very much the impact of the coronavirus was very much looming over this budget, and lots of commentators in the press overnight have talked about that. And it hugely influenced the spending measures that were announced. And in fact, I've listened and involved in budget speeches for over 30 years now, and after this is the first time I've seen so much focus on expenditure rather than tax raising from a Conservative Chancellor, probably actually more so sometimes than some Labour Chancellors too. And part of that was because of the need to address the impact of the coronavirus, particularly dealing with the spread of the virus, the economic impact on the economy as a whole, and also on the impact on individuals. So the Chancellor has announced a £30 billion of funds have been made available to deal with that impact, as well as a promise of pretty much a blank check for the NHS. I think the Chancellor said that he would provide whatever it took to help the NHS to cope. In terms of giving some context for Guernsey around what 30 billion would look like, in our context, the 30 billion pounds expense would be the equivalent of spending 30 million pound on dealing with the virus. And I don't know what states and PNR's plans are, but I don't think their plans are to spend £30 million on dealing with the coronavirus, but we'll see. The other factor looming in the background over this budget was the promises made in the Conservative Party's election manifesto. So we've seen a number of large infrastructure investments announced, and particularly a £27 billion roads programme and a £2.5 billion to fix the nation's potholes. And I must admit, I struggle to see how a £27 billion roads programme fits in with the desire to move towards a greener economy. But I'm just a humble tax advisor, so I'm not aware of how those two match up. Anyway, so as always, with these events, our focus is on the measures that have been announced that are relevant to Guernsey business. So we're not going to look at everything that's in the budget. And as I'm sure you'll have read from the sort of media commentary yesterday afternoon and overnight, there weren't actually a lot of tax raising measures announced in the budget. It was very much a spend rather than tax budget, but there were some details that are relevant to to Guernsey that we're going to look at, plus some of the future consultations that are coming down the line and the impact they may have. And again, as we try and tend to do at these events, take the opportunity to consider other tax developments more widely that we think are of particular interest to business here in Guernsey. And the ones this year that we think are worth looking at are what people are referring to as DAX 6, which is the European Union's mandatory disclosure regime. So I want to very quickly look at that and how it impacts, and it will impact on us here in the islands. The OECD has a latest work program on what they refer to as the digitization of the economy, which many people are referring to as BEPS 2.0. And since this is a presentation by Guernsey tax advisors, it wouldn't be right not to talk about substance. But actually, in this instance, we want to talk about the potential impact of the coronavirus on companies' ability to meet the substance requirements. So with that context, I'm going to hand over to Paul, who will look at the measures in the budget.
Thank you, Tony. Morning, everybody. I want to echo Tony's sentiments that it's a shame not to see you all this morning. It's a shame not to see you both this morning, but I'm sure for those of you who know us, you'll agree that we're two men with faces for radio. So I'm going to talk about a few of the measures that have come in the budget yesterday. And sort of, as Tony mentioned, doing it from the perspective of a Guernsey angle. It's clear that the budget yesterday was focused more on expenditure than raising income. And so a lot of the high-level measures weren't tax-related, but there are some things in there that are worth going through. From an income tax perspective, the personal allowance is frozen at £12,500, and the income tax rates and thresholds haven't changed. Similarly, the dividend and savings allowances remain consistent, but have noted that the lower earning limit for national insurance contributions has increased. For those of you who attended last year, you'll recall that we did a comparison of an individual making £50,000 per year working in Guernsey and working in the UK, and we noted at the time that it was increasingly less attractive in certain circumstances for those types of people. And I think that largely remains the case. It'd be fair to say that our business and many other businesses on the island face challenges recruiting high quality staff. And I think that this is a challenge that it would be worth considering how we address. And conversely to that, one of the most reported measures in yesterday's budget that was sort of released beforehand was around entrepreneurs relief. It was widely touted that it might be removed altogether, but what actually happened was that the lifetime limit was reduced from £10 million to £1 million. For anyone who's not familiar with how entrepreneurs relief applies, it's broadly where you dispose of trading companies or assets of trading companies, and in such a case, gains on a disposal would suffer a lower rate of capital gains tax up to the limit. So it was 10% as opposed to a normal rate of 20%. So the reduction from 10 million to £1 million would clearly make a difference for people who are disposing of business assets. And why I think this is obviously really relevant to Guernsey is that people disposing of their businesses has long been a push factor from the UK to the Channel Islands for high net worth and entrepreneurs looking to benefit from the fact that we don't apply capital gains tax on such a disposal for residents of the island. So I think this, coupled with some of the tax capping measures that we brought in recent years for new arrivals, continues to make Guernsey a front runner from a tax perspective for people who are UK resident but might be looking to enjoy island life. A couple of other things. The corporation tax rate is announced to remain at 19%. We did know this before the budget, but it's also confirmed that it will stay at 19% for the financial year beginning in April 2021. I see this as relevant to us in two perspectives. The first is that sort of following the Brexit vote, there was some conversations around whether or not the UK would try and position itself as a low tax jurisdiction, becoming a bit of a competitor of ours. I don't think that line of thought had sort of continued to date, but this confirmation does accentuate the difference in rates between Guernsey and the UK. And second to that, from April 2020, as I'll talk in quite a lot more detail about later on in the presentation, non-resident landlord companies will fall into the scope of corporation tax. And so the rate applicable will be 19% as opposed to the 17% that was expected when the transition was initially announced. From an IHT perspective, the nil rate band remains at 325,000, and the main residence relief band has increased to 175,000 from 150,000, which is as planned when that relief was initially introduced. There were some property changes. You would have noted the proposed stamp duty surcharge for non-residents, but I'll talk about that in a later section. But first, I'll pass back to Tony to talk a bit more about some of the consultations issued yesterday.
Thank you, Paul. As always, Chancellor announces a number of consultations on future changes, and also sometimes some of these announcements are also tucked away in the detailed documentation that accompanies the budget speech. And there are a couple of things in there that will be of interest or of direct relevance to Guernsey, depending upon how they pan out over the course of the next year or so. The first one I wanted to look at was the announcement of a review of the UK fund regime. Now, it's not explicitly stated in either the speech or in the documentation, but clearly or the intention here is to explore the opportunities for the UK fund industry that will be arising from the UK leaving the European Union. The very little they've said about this review is that it will cover tax, both direct tax and indirect tax, so corporation tax, VAT, etc., and will also include regulation. And the government have also said they're going to set up an industry working party to specifically look at VAT on financial services, including VAT on investment management fees. So which I suppose seems to fit in with both taking the opportunity with leaving the European Union, and also part of the agenda that both this government and previous governments have had about making the UK's investment management industry even more competitive than it already is. Now, interestingly, this review will obviously take place alongside the negotiations on the future trade arrangements with the European Union. So it'll be interesting to see just how much divergence we end up with the proposals for a new regime based with the current EU rules. And in many ways, and this is where I think it is directly relevant to us here on the islands, it'll be interesting to see how the outcome how the outcome will have an impact upon our industry in terms of does the UK become a competitor to Guernsey, or actually does it open up greater opportunities for us? And that question about opportunities just ties in with the second point that was mentioned, which was about doing some consultation and work around granting market access for Gibraltar financial services. Now, you wonder why has Gibraltar been singled out, but basically it's because at the moment Gibraltar, like the UK, falls under the EU rules, and therefore Gibraltar is treated as an EU member state, and therefore it has free access to the UK marketplace. So really, what the consultation is doing is just seeking to understand how it can leave Gibraltar in the same position post-Brexit as it currently is. But given the consideration around market access to one overseas territory, you just wonder whether or not there will be opportunities for Guernsey to focus on giving market access to current dependencies, in particular thinking about us here. So that may be some great opportunities for us arising from that particular review. Other things that have been talked about, I suppose the government has now finally run out of tax avoidance measures or anti-tax avoidance measures themselves, and now continuing their focus on the promoters. Now, we already had previous budgets where they've announced bringing in measures to tackle the people who promote aggressive tax avoidance schemes, and it continues to be in the press with a lot of controversy around the loan arrangements that have been put in place over the years for a lot of individual contractors. And what the government is talking about here is looking at ways to strengthen the regime that we'll call DOTAS regime, which is the regime that requires promoters to provide details of avoidance schemes that have been developed and marketed, making it easier for HMRC to bring penalties both more quickly into the process, and perhaps harsher penalties as well, to beef up the existing provisions around controlling promoters more generally, and also talking about possibly making some changes to the general anti-avoidance provisions, so the GAR. Now, again, don't necessarily see there be a direct impact here in Guernsey from that tackling that focus on promotion of tax avoidance. But it's interesting to see that HMRC still feel the need to strengthen their powers to address this, given the additional powers that had already been given in previous years. And at the same time as this, the government's also announced a wider review of the tax advice marketplace, and I think there's a relationship there around. I think there have been concerns, and we saw that around the fuss around the loan arrangements over the last few years, around the standards of tax advice that is available to taxpayers. I've just realised a spelling mistake on the slide. It should say raising standards in the market for tax advice. Not tax avoidance, slightly different, and it's basically looking at what I imagine is looking at the players in the marketplace and probably look at bringing in some form of additional regulation for tax advisors to make sure that the taxpayer is getting better quality advice and advice on which they can rely. And the final point, which I will just touch on, something that perhaps is close to many of our hearts because it touches upon airline links and transport, announced a review of the aviation tax reform, again prompted by the opportunities arising from Brexit, and specifically looking at the imposition of domestic of airport passenger duty on airline passenger duty on domestic flights, which is something I know that the ARENA and the Economic Development Department have always been concerned about, that the way that we're treated from Guernsey perspective makes the cost of travelling to the UK more expensive. So the hope is that upon the outcome of that review of the ADP regime in the UK, maybe cheaper flights for us in travelling to the UK from Guernsey. On the last thing I just wanted to look at very quickly on in terms of sort of future developments, again, something that isn't directly relevant to us is around the work on the digital services tax. This was announced in the budget last year and comes into effect from April 2020. So the first year of apply will be the tax year 2020-2021, and it introduces a 2% tax on the revenues. Stress tax on the revenues of certain digital businesses which derive value from UK users. So it's seeking to address the problems around the concerns about the relatively low rates of tax paid by businesses such as Facebook and Google. So this 2% revenues tax will apply to revenues generated from the provision of search engines, social media platforms, and online marketplaces. So you're looking at Google, Facebook, and Amazon sort of front and center in that, and it applied to the revenues linked to the participation of UK users, and it'll only apply to groups that generate global revenues from the relevant activities in excess of £500 million per year. So it's very much focused on those big US businesses, and it is therefore causing a little bit of tension with the US. But what's so particularly relevant in the budget, and why the announcement they made in the budget this time was that the recognition that this is a unilateral move by the UK. I think France is doing something similar, and other countries are also considering similar things. But the UK recognises that this is a global problem, and it requires a global solution. So they're actually saying that they only expect this provision to be in place for as long as it takes there to be a multilateral global solution to be reached. And if you actually look at the sort of the spending plans and the revenue raising expectations over the coming years, the digital services tax is only expected to raise £65 million in tax year 2020-2021, and virtually nothing from thereafter. So it looks like the HMRC or the Treasury expect to be generating revenues from whatever that multilateral global solution is from 2021-2022, and it's something I'll pick up on later on when I talk about the OECD work on the digitalization of the economy. So that's all I wanted to cover there, and I now hand back to Paul, who will focus on some of the changes both in the budget and previously on property taxation.
Thanks, Tony. Before I start, it's been raised that there were some audio issues during my last segment and possibly some connection issues. Joni's posted in the chat room, anybody who is experiencing connection difficulties, press the reconnect button and it should refresh. Hopefully you'll be able to follow us quite clearly. So from a property perspective, it was included in the Tory manifesto, very widely reported prior to the announcement, but confirmed yesterday that there will be a stamp duty change, and the change will be with effect from April 2021, and it's proposed that a 2% surcharge will apply on purchases of UK residential property by non-UK residents. This sort of continues the Treasury's focus on overseas ownership of UK residential property, and it could see a top rate of stamp duty land tax of 17% applying to purchases of property over £1.5 million. Slightly better news, I suppose, for some is that for those investing in UK commercial property, the structures and buildings allowance increased from 2% to 3% in the spirit of this being an infrastructure budget. Confirmation yesterday as well that as we did already know, that non-UK resident companies with UK property income will be transitioning from the income tax to the corporation tax regime. And this is clearly going to have quite a large impact for a number of entities run from Guernsey, as the corporation tax regime is very different from an administration perspective, and it is more complex technically, and a lot of us have been very used to the income tax regime, filing SA 700s, etc., for many years. It's noted that the policy measure is not anticipated to raise any revenue for the government, but it is perceived to ensure equal treatment for similarly operated UK and non-UK property businesses. From an admin perspective, there's a few things to note. Companies should have started receiving notices from HMRC already and should certainly receive them by the end of June. This will notify them of their unique tax reference number. It will provide information about steps they need to take, such as registering agents and registering for corporation tax, etc. And re-registering the agents and refiling 64(8) will be necessary in a lot of cases. I want to stress that if you are running a company that should fall within the scope of CT and you haven't heard from HMRC, please take the initiative to speak to your tax advisor and notify HMRC of your chargeability. Continuing with the admin, the standard deadlines for CT are that payment is due 9 months after the accounting year end, and tax returns due to be filed 12 months after the year end. For large and very large companies, there is a quarterly instalment payment regime, but that won't apply in the first year of transition. Both the tax return and accompanying financial statements will need to be iXBRL tagged. This requires specialist software, as does the filing of the corporation tax return generally. It's also worth noting that for companies that don't have a 5th April year end, the straddling provisions will apply. And what that will mean is that for the first part of the accounting period, the company will need to file a non-resident landlord SA 700 tax return. And for the second part of the accounting period, a CT 600 corporation tax return will need to be filed. Appropriately apportioning income and expenses and applying the right treatment is obviously going to be key to that. From a technical perspective, there's a number of things which apply under CT which have not had to be considered previously, and probably the biggest one being interest relief. Under the non-resident landlord regime, the primary consideration is whether or not the interest is incurred wholly and exclusively for the purposes of the rental business. If it is, then it's deductible against rental profit. Under corporation tax, interest in itself is not a deductible expense. Instead, it's subject to the loan relationship rules. Practically, a lot of the companies, certainly that we deal with, and a lot of the companies holding property in the island, are not going to be massively affected by this, as the levels of interest where restrictions apply can be quite high, and oftentimes the £2 million group allowance won't be reached. But if you do have highly geared structures, or you do have large groups, then these limits can come down, and it could be in fact impactful. Where corporate interest restriction could be in play, the calculations to work out what the allowance is for each company and each group is complicated, and it can require the filing of a specific return. One of the other key differences is loss relief. Again, the income tax rules are fairly straightforward. losses can be carried forward and utilised in full. As companies sort of move from income tax to corporation tax, there are two categories of loss. The first is income tax property losses, which are any losses that arose prior to 6th April 2020. And these are given full flexibility and can be offset in full against future rental profits without restriction. Where losses arise after the 5th of April 2020, there are two separate categories, and they're both treated the same. The first is corporate rental losses, and the second is non-trade loan relationship deficits. And both can be offset in the same way. First, they can reduce total income and gains chargeable to UK corporation tax in the year. Secondly, they can be group relief to 75% group companies with profits subject to UK corporation tax. And thirdly, they can be carried forward, but the carry forward is a key difference. It is restricted to £5 million plus 50% of the profits above £5 million. The budget announced yesterday, confirmed that capital losses will be subject to similar restrictions. There are lots of other complicated measures, such as the anti-hybrid mismatch rules and things like that. The point really being here that on the face of it, the transition to CT would seem like just a slightly lower tax rate, but there are actually a lot of other things to consider for impacted entities. Next, I just wanted to touch on something that actually came in from April 2019. The reason why is that there are certainly for some fund structures, but for other people as well, there are some actions that ought to have been considered and should be considered prior to the 5th of April. As most of you will be aware, rules have applied since April, which significantly widen the extent to which UK tax applies to gains realised by non-UK residents. Specifically, measures included tax on all UK land and real estate, including commercial and land, as opposed to where previously only UK residential property had been in scope. Also caught are the indirect disposals of property-rich entities. I mean, a property-rich entity is broadly one where 75% of its value derives from UK property. And so where this might apply, for example, would be tax on a gain realised on disposal of shares in a Guernsey company which held UK property. If the value of the shares was derived primarily from UK property and the investor had held a substantial interest, being 25% in the company within the prior 2 years, then that gain would be subject to UK tax. A little bit on the filing practicalities. For individuals and trustees, they're required to file non-resident capital gains tax returns within 30 days of any disposal, irrespective of whether gain or loss is made, whereas companies need to register, if they're not already registered, and file corporation tax returns. As noted, the NRCGT returns are required irrespective of gain or loss, but for corporation tax returns, if the company has made a loss or is at a no gain, no loss position, then it only needs to file if it wants to be able to make that loss. It wants to be able to claim that loss and carry it forward. So for example, if you had like a single property holding company that was essentially going to liquidate after the disposal of the property, it made a loss or no gain, no loss, it wouldn't need to file a CT return. And one area where we've been sort of heavily consulted in recent months is in respect of collective investment vehicles. The default position with regards to taxing gains in collective investment vehicles is that they're treated as companies, and in the absence of any election, they're subject to corporation tax on any gains arising from the disposal of property, as well as their investors being subject to either CGT or capital or corporation tax on disposal of their interest in the SIV, if it's property rich. Important thing to note is that the 25% ownership threshold doesn't apply to disposal of an interest in a SIV. So say, for example, a Guernsey resident who holds a minor percentage in a property-rich SIV and makes the disposal would be taxable on any gain arising to them. The first thing that you've got to do is establish whether the entity actually qualifies as a SIV. There's a number of ways in which it can do. Firstly, it can be a collective investment scheme under the FSMA 2000 definition, section 235. It can be an alternative investment fund under regulation 3 of the Alternative Investment Fund Managers Regulations. UK REITs qualify, and broadly the offshore equivalents of UK REITs also qualify as a non-close, non-UK company that meets a UK property condition. The UK property condition is broadly that the manager can reasonably expect no more than 25% of gains realised by investors to escape UK taxation by virtue of a double tax treaty. This is really focused on structures with Luxembourg investors because they've got kind of an unusual double tax agreement with the UK that can remove gains of this nature from UK taxation. Once a entity is happy that it qualifies as a civ, it's got two potential elections that it can consider. The most common so far has been the transparency election. The transparency election applies to entities that are transparent for UK income tax purposes. In the real estate world, this is mostly GPUTs and JPUTs. They're the key vehicles. If the civ is a unit trust and it can make the transparency election, which treats it as a partnership for gains purposes. And what that means is that the civ's transparent and its partners are direct, and its unit holders are directly accessible on the gains. The transparency election is a one-off election, and for existing funds, they have to have made it by 5th of April 2020, and it is irrevocable. Sorry. For the exemption election, firstly, the entity has to qualify as a civ, and then it has to meet a further qualifying condition. It either needs to meet the genuine diversity of ownership conditions in the offshore funds rules, or it needs to be a body corporate and meet the recognised stock exchange condition, or meet the UK tax condition and be non-close. The exemption election doesn't need to be made straight away. It needs to be made within 12 months of the first time that the entity wishes for it to apply. And the what it results in is the entity being an exempt entity for these purposes, but the trade-off is quite extensive annual reporting. I'm sure that most property rich civs have already done these reviews, but I just want to re-emphasize that there are some things that need to be thought about prior to 5th of April. So if you haven't considered it, you should do so. Very brief summary before I pass back to Tony then. SDLT surcharge from April 2021. I haven't mentioned it yet, but ATET rates increased by inflation as they usually do. Capital gains tax rates have remained consistent, and a slight increase in the annual exemption. Corporation tax rate retained at 19%. Gains have been in place for non-residents on all UK property from April 19. Civ should review their structures if they haven't already to see if there's anything that needs to be done before the 5th of April. And all companies should be receiving notification of their chargeability under CT in the next few months. With that, I'll pass on to Tony.
Thank you, Paul. So that's pretty much covered everything we wanted to in terms of what was in the UK budget speech yesterday. Now I wanted to move to I said other developments that I think are going to be relevant and pertinent for us here in Guernsey. First one may not seem relevant at first sight, and that is DAX 6. So DAX 6 is the European Union Directive on Administration Cooperation in its 6th iteration. I think iteration number 4 of the Directive on Administration Communication was the Common Reporting Standard. So that DAX 6 is introduces an obligation across the European Union for EU intermediaries. So it's purely an obligation for intermediaries. It can be taxed in certain circumstances. The obligation on the intermediary to disclose potentially aggressive tax planning arrangements to their tax authority, and for the tax authorities themselves then to exchange information with these structures with other relevant jurisdictions. So, for example, if there was a French intermediary was advising on something that impacted on German taxpayers, then that information would be passed by the French tax authorities to the German tax authorities. So it requires the reporting of cross-border arrangements that fall within a set of what we call hallmarks. So it's essentially, the EU has defined what are the particularly aggressive types of tax avoidance that they're seeking to combat. So if you meet those hallmarks, then have to be reported. Some of those hallmarks, there's 5 different hallmarks, and 2 or 3-ish of them also have a main benefit test, which basically, if they only have to be reported if one of the main benefits of a particular arrangement was a tax advantage. So it's interesting that it focuses on the benefit, not on the purpose. That's not what the intention behind the transaction was, but on what the actual effect is. And The report needs to be made by the intermediary within 30 days of the arrangement being made available to the taxpayer. And as you can imagine, there's quite a lot of detail around what is a hallmark, what's cross-border arrangement, main benefit test. Just to give you an idea, I spent an entire day looking at this on Monday, and there's probably still to look at. So you'll be pleased to know we're only going to spend about 5 minutes on it. But it is relevant, and you'll see why in a second here. Essentially, what's there's a 30-day reporting deadline, and you need to determine, an intermediary needs to determine, is it a cross-border arrangement? Is it reportable? So does it meet one of the hallmarks? If so, then who has to report? Because if, so the rules apply to EU intermediaries. If there isn't an EU intermediary, but there is an EU taxpayer, then that obligation to report falls upon the taxpayer. So that's one area where we could be effective here in the Channel Islands, where we may be advising on a structure, or we may be involved in the implementation of a structure. Because the intermediaries are not just the entities which actually devise and advise on setup structures, and not just the lawyers and accountants. It also captures entities which are involved in the administration, management, or establishment of structures. That can capture banks, trust companies, fund administrators, etc. as well. So if there's no EU intermediary, then your reporting obligation falls upon the taxpayer. And then you need to tell me what actually is that needs to be reported to the tax authority. Why we believe it's relevant here, so I'll get to it in a second, just after, in terms of deadline, deadline is, the directive was passed on the 25th of June 2018. It actually reporting, the obligation to report commences on the 1st of July this year, but there's a catch-up. So between the 1st of July and 31st of August, intermediaries are required to identify and report all relevant reportable arrangements that took place between the 25th of June 2018 and the 1st of July. So actually, if you're a court, you should be collecting details of reportable arrangements now and report them between the 1st of July and 31st of August. And equally from the 1st of July, you have to report within 30 days on relevant arrangements that are made available from the 1st of July onwards. And then 31st of October, that first exchange between tax authorities will take place. So where I think this is relevant for businesses in the Channel Islands is about who needs to disclose. So the obligation, as said, falls upon an EU intermediary. And just to be clear, the UK has adopted DAC 6. So notwithstanding the fact that the UK is not part of the European Union, they have adopted the DAC 6, and it is now the legislation to bring DAC 6 into law is in place in the UK. So there is, the equivalent legislation to DAC 6 is now UK legislation. The statutory instrument and regulations are all in place in the UK. So when we talk about EU intermediaries, we can also talk equally about a UK intermediary. And the definition of a UK intermediary or an EU intermediary is, an easy one is you have a resident in a member state. So UK resident company, UK resident accounting partnership or legal partnership would be a UK intermediary for these purposes. But one of the other one of the ways you're caught, as well as being a resident, you can be caught if you are registered with a professional association relating to legal, tax, or consultancy services in a member state. So, for example, if you were an accounting firm that was registered with the ICEW, or if you're a law firm that was registered with the Law Society of England or the Scotland, then you could be caught as an organisation. But equally, an employee, normally an employee of a firm is not caught if the firm itself is an intermediary. If, however, the firm isn't an intermediary, but the individual who is providing advice is themselves registered and regulated by a professional association relating to legal, tax, or consultative in a member state. So if you are a member of the Chartered Institute of Taxation or the ICEW or the Law Society, the likelihood is, and certainly from CIOT's perspective, they've said it will apply, the likelihood is that you'll be expected as an individual, if you're practicing outside of the UK and you're advising on relevant transactions, then you will have a reported obligation to the UK because you'll fall within the definition of a UK intermediary. So there could be a number of people, myself included, who will be caught as a UK intermediary as a result of these rules here. So therefore, for example, we're here at KPMG and now having to go through a process of identifying the transaction that we advised on was since June 18 and putting in place procedures to be able to report from 1st of July onwards. And I don't expect that we are the only people affected in this way. So that's why I think it is something that actually we need to think about here in a way that perhaps people hadn't necessarily realised, and I certainly hadn't realised until a couple of months ago, that we were likely to be caught. Just as an aside as well, before I move on from the subject of mandatory disclosure regimes, just a reminder that Guernsey will be introducing its own mandatory disclosure regime. The good news is it's not going to be as complicated as DAX 6. What we're introducing is the OECD mandatory disclosure regime, which just focuses upon basically common reporting standard avoidance schemes. So schemes are designed to avoid reporting under CRS and opaque offshore structures. So my understanding is that the enabling legislation was passed at the end of last year, because that was part of a commitment that we have made to the European Union under our and getting ourselves whitelisted for substance purposes. We also made this commitment to introducing an OECD version of the MDR. So that would apply. The law is in place, but the detail, regulations and guidance will be made available some point over the next couple of months or so to understand how that's going to work in practice. But as I said, it is essentially the OECD version around CRS and opaque structures. That is one of the 5 hallmarks, includes that one, but we're only introducing that 1 hallmark essentially, whereas the EU DAX 6 applies to 5 hallmarks. So if it's certainly worth looking at your businesses, but if you have people who are qualified with UK institutions, to determine whether or not you're actually going to be caught and required to report as an UK intermediary, or equally if you have people who are members of EU institutes who may do similar things. So it's just something to be aware of, and so it comes into effect from July this year. This last thing that I wanted to focus on was the work, as I mentioned earlier on, the OECD's work on the digitization of the economy. So BEPS 2.0. So BEPS 1 was initially was around actually dealing with the challenges to the global tax regime, global tax regimes that are presented by increasing both the internationalization of business, but also it's like the digitalization of business, where business you could transact to a significant degree with a jurisdiction without ever actually stepping foot in it, as we see the likes of Facebook, Google, etc. So the various sort of 15 action points that came out of BEPS 1 were supposed to address all of those. And it's interesting that at this point in time, essentially, there's been a recognition that they probably haven't actually addressed what they wanted to address. Despite those 15 action points, they probably haven't addressed it. So the BEPS 2.0, the specific work streams on digitalization is supposed to go a step further. And the work streams are the 2 work streams, or pillars, which have been, as I referred to, as pillar 1 and pillar 2. This is now taking the focus of the OECD. So all the people that are working on treaty abuse and transfer pricing documentation, all the other various action points there, are now focusing on pillars 1 and pillar 2 and really working on getting some global consensus. So pillar 1 of the work in digitization of the economy is how to allocate profits to the operating centers in a digital business activity. So this is to pillar 1. If you remember the comments I made about the UK's digital services tax, well, the UK expects there to be something coming out of the work on pillar 1 that will address what digital services tax in the UK is seeking to address. And actually the OECD have made quite a lot of progress on pillar 1 around that sort of allocation of taxable rights. With expect to make some reasonable progress on that. Overall, on this work program, the OECD have set themselves a very ambitious target. They're going to have proposals on final position by the end of 2020, but actually the movement they're supposed to be, I stress they're supposed to be, because the way things are being cancelled at the moment, who knows? There's supposed to be a G20 meeting in Saudi Arabia in its summer, where they expect to be able to report and bring together some proposals. From our perspective in Guernsey, where it's more of interest, and I use the term interest very loosely, is pillar 2. And pillar 2 actually goes beyond just the digitalization economy. This is looking about the whole concept of how to determine and to apply a global minimum tax rates on multinational enterprises. So actually looking at global businesses that operate multinational enterprises across jurisdictions to ensure that they pay somehow a minimum level of taxation. So this is one that will impact upon us, because this isn't limited to just looking at digital business. This is looking at the economy as a whole. And this is also an area where the OECD is finding it slightly more challenging to reach consensus, but they are moving towards some kind of consensus. So what they've come up with is a global anti-base erosion proposal, or GLOBE, which is a slightly torturous acronym they've come up with. And GLOBE, the areas they're looking at is both in terms of determining what that minimum tax rate should be. They're looking at somewhere between 10 and 15% at the moment, and how that will be impacted would be by way of denial of tax deductions, perhaps of having a minimum rate being applied at the level of the home country of the multinational's head office is based, perhaps considering some form of blending of tax rates. So if you have a high tax rate in one country and a low tax rate in another, can you blend them together at the head office level to make sure you then arrive at that minimum tax rate? Now, this could present some significant challenges to us, but it also could actually pass us by completely. And the reason I say that is because some of the solutions that talk about including limiting the application to multinational enterprises only to multinational enterprises which currently report under country-by-country reporting, which has a threshold of 750 million euros. So it's possible that if the business falls beneath that 750 million euro threshold, they wouldn't be required to comply with this minimum tax rate. There is also talk about a carve-out for financial services businesses, in particular funds. Again, that's probably would be the best possible outcome for us. There also is talk about exemptions for entities that have got sufficient substance, or for territories with sufficient substance. So at the moment, we don't know how it's going to impact on us. It's certainly, one possible outcome is it could impact on our ability to offer zero rate tax. But on the other hand, if you have a full blending, it wouldn't do, or if you have an exemption for financial services, it wouldn't do. So at the moment, we really don't know where this is going to land. There was a lot of hope that perhaps they wouldn't be able to reach consensus, but unfortunately, the OECD do seem to be moving in that way, and there is quite a lot of political will behind this. And we should get a better idea at some point in the summer of the work that they're going on, because there was a meeting going on just now, partly in Paris and partly virtually because of the coronavirus, as I understand, to move forward on the work on both Pillar 1 and Pillar 2. So I think it's very likely that over the course of the coming few months or so, we may well have another presentation around the potential impact on Pillar 2. So watch this space. So the last point, which I should now hand over to Paul upon, as I said, it wouldn't be right to talk about tax in Guernsey without talking about substance. So I'll hand over to Paul to deal with that.
Thanks, Tony. I know a lot of people have attended numerous seminars on substance and are going to be very familiar with the rules, their application to companies they run. So I'm really not going to be detail heavy this morning. However, we can't ignore the subject because unfortunately, over recent weeks, we've been faced with quite a large number of questions relating to the difficulties with meeting obligations by virtue of coronavirus. I can see from the chat room on this webinar that a number of people have been talking about that already this morning. Now, to be absolutely clear, for the avoidance of doubt, neither Tony nor myself have any expertise whatsoever from a medical perspective, and we're not an authority of any sort in respect of what type of action is proportional and what's not. It's clear that the most important thing is that people put the well-being of themselves and families first and foremost. What we'd like to know a little bit about is the economic substance rules and how they work. And we've been fortunate enough as a firm in recent days to engage with both the Jersey and Guernsey revenue authorities to be able to speak a little bit this morning about some of the practicalities. Quick refresh of what's happened since our last briefing. The new Guernsey corporate tax returns have been released and are live. The bulk returns are a thing of the past, and every company now must file an individual corporate tax return. And all bar dormant companies are required to file certified accounts. Companies have continued to be filing with the Revenue Service to either let them know they're Guernsey resident by virtue of management control, or that they're non-resident by virtue of management and control, forms 706 and 707 being the relevant ones. And we're in the midst of starting to gather information from our clients for preparation of tax returns and assisting a number of administrators for the first tax returns in the economic substance era. From our perspective, the task is significant. The volume and complexity of information is sort of unprecedented from a Guernsey tax perspective. And then finally, we've as mentioned, we've had the coronavirus really seeing a fundamental change to what business as usual is. So we have to have a quick recap of the rules, so that we can understand why it's impactful. When you're considering if a company is in scope of substance from a Guernsey perspective, question 1, is it a Guernsey resident company? If the answer is yes, question 2, is it undertaking a relevant activity? Provided both of those are answered positively, then you enter into the subject to the economic substance regulations. As you'll all know, it's a 3-part test. Part 1, is the company directed and managed in Guernsey? Part 2, does the company undertake its core income generating activities in Guernsey? And 3, does the company have adequate people, premise and expenditure in Guernsey? In terms of the coronavirus impact, and our short chat this morning, focus on the first 2 parts of the first 2 tests. There will be where we continue from now. Starting with the directed and managed test. So just to, what's on the screen is an extract from the regulations. It shows what the directed and managed test determines. And the bit highlighted is deliberately bringing focus to the fact that the board must meet an adequate frequency, and the board must have a quorum of people physically present in Guernsey. What I'd recommend is that companies are reviewing their articles, ensuring they know what their quorum is, and consider whether there's risk or not for any of their upcoming meetings that these requirements may not be met. In terms of core income generating activities, again, the extract from the regulations is on the screen, and you'll note the focus here is on the majority of those making the decisions being present in the island when the decision is made. So that's the majority rather than the quorum. This is going to really mostly be relevant where we're looking at the decision making of the board to undertake core income generating activities. I think fund management and finance and leasing are 2 of the relevant activities that most likely to be impacted. And I just want to re-emphasize that difference with where directed and managed is for quorum, and for SEGA it's the majority. We've seen a lot of cases where they're the same, and we've seen a lot where they're different. So understanding that and challenges with the 2 tests is important. So what's been happening? As you can imagine, it's March. A lot of companies are holding core board meetings. This has caused a huge issue for people not based in Guernsey who plan to attend Guernsey board meetings, but they're unable to do so due to travel policies either that they've chosen to take or been required to adhere to. There have been cases already, and there will undoubtedly continue to be cases where meetings can't be quorum, and certainly where the majority of decision makers can't be on island. The revenue services of Guernsey and Jersey will both seek to be pragmatic and recognise the challenge faced. I don't think this, and we'll come in a moment to the release from Jersey yesterday, but I don't think this should be mistaken for a substance-free pass. Our advice is review the rules, review your articles, and understand where you're going to be challenged to comply with the test. It's the sorts of things that I think people should be thinking about. If you have a mix of resident and non-resident directors, if there are meetings where it may be that some of the non-resident directors are not critical, you may consider them not dialing in so that the board still meets either the majority or quorum test where necessary, because it is preferable that companies do not fail either part of the test if avoidable. It may even a bit of a more future planning, and now might not be the time, but if you are finding these challenges insurmountable, it might be it may be something to consider the future makeup of the board to better be able to meet the substance requirements when faced with unanticipated circumstances. However, we're not going to pretend that people can make arrangements in all cases to avoid this. Unfortunately, the revenue services are not doing so either. The Jersey Minister for Treasury and Resources released a statement yesterday which says where companies' operating practices have to be adjusted to compensate for coronavirus outbreak, the comptroller will not determine that a company has failed the economic substance test. The treatment will only apply to adjustments to the normal operating practices and to the extent required to mitigate the threats from this outbreak. I think that I want to, so that's obviously extremely welcome. Our conversations with the Guernsey Revenue Service have been similarly pragmatic. But I would stress that the treatment really is as a sort of to say where normal operating practices are being impacted. I don't want this to be misunderstood, and I think that from our conversations, the absolute key thing here is documentation. Companies are advised to document the rationale for everything that relates to such matters: who was there, who wasn't there, why they weren't there. Document the policies relating to that, to their absence. The audit trail is always key in substance matters, and I think it's never been more relevant than now. It won't always be possible to sort of take the right side of the rules, but we obviously advise that where it is feasible and not detrimental to you or those that matter to you, that you try to do so, and where you can't, we just re-emphasize, document everything. With that, I think that brings us up to date on where we are and the challenges we've faced, and I'll pass back to Tony for closing.
So there was a question that was asked about DAX6 reporting, about to whom is reporting made. If you only need to report if you are caught as a UK, probably be caught as a UK intermediary. So if you recall, I talked about how you might be caught as such. If you are a UK intermediary, then you report to HMRC because you're reporting as the UK. So nothing gets reported to Guernsey under DAX6. You report to the UK. Where reporting is done to Guernsey is when we start reporting under our local mandatory disclosure regime. So if you report under the Guernsey regime, you report to the Guernsey Tax Authority, who will then share information with the relevant other overseas tax authorities. If you're reporting under DAX6 because you're caught as a UK intermediary, then you report to HMRC. So I hope that clears that up. Another question that was asked was, does Pillar 2 impact on the 0% tax rate companies? It could do, I think, sure. It could do, depends upon how it actually finally pans out. So we need to see how that develops. So just a quick look. I don't think there are any other questions, which probably actually works out quite good timing. That brings us up to virtually the hour. So it just remains for me to just say the recording of this webinar will be made available later on today. So if you want to hear it again, on slides will be there as well. It will be available for you to do that. It just remains for me both, first of all, to thank Paul for his time and Joni Free, who's the one that actually made this whole thing work silently in the background. And to thank you all for your time and attention. I hope that you found this format useful. I'm expecting, he says, crossing his fingers, that will be returning to our normal format come the autumn when there is another budget there. But who knows? We are in unprecedented times, so who knows what we'll be doing the next time. But now in the risk of sounding like a breakfast show presenter, I wish you all a good day and hope to see you again soon. Thank you.